Sir, we are just waiting on Mr. Ankit. As soon as he joins, we'll begin.
Sure. No issues. I'm on mute. I'm waiting for Ankit and
Sure, sir. Thank you, sir.
I'm Radul.
Hi, Himanshu. Good afternoon.
Good afternoon. Hope all well.
Yeah, you too.
Yeah.
Hey, Himanshu. Hey, Mridul.
Hi, Ankit.
Hi.
I can now see you. We just
Welcome,
saw a blank
Ankit.
screen. Yeah.
Sorry about that.
So, as soon as you all are ready, we can start.
We're ready, man. Whenever you can start, we are ready to start.
Sure. So, good afternoon, everyone. We'll now reconvene. Welcome back, ladies and gentlemen, to the first day of proceedings of the annual convention 2020. We hope you had enjoyed the Techathon session before lunch. Now we'll begin our first among the two fireside chats, which is on the topic Role of Technology in Wealth Management and Insurance.
We are privileged to have with us Mr. Mridul Upreti, the moderator for both our fireside chats. Mridul Upreti is a sector lead in tourism, retail and property, Asia Pacific at International Finance Corporation. He is an experienced professional with about 20 years of experience in the commercial real estate industry.
In his previous corporate role, he was the senior advisor, housing finance at FIG. He has also worked with JLL and was the CEO of Segregated Funds Group. He has professional skills in valuation, investments, portfolio and asset management. With interest in technology and startup investing, he is also an angel investor.
Mr. Upreti is a distinguished alumnus of DFS and has been a visiting faculty for the department. He possesses deep knowledge of practical realms of the current business environment and emerging trends in fintech. We welcome you, sir. Thank you for sparing your precious time. And as a token of gratitude, we have planted a tree in your name. It's trackable via the ID shown in the certificate, and we will be sending you it over the mail also.
Thank you. Glad to be here and look forward to the discussion.
We are also privileged to have with us Mr. Himanshu Kohli. Sir, Himanshu is the co-founder of Client Associates. He has over 2 decades of experience in the areas of investment banking and private banking. Prior to setting up Client Associates, he worked with Deutsche Bank Private Banking, DSP Merrill Lynch, and London Forfeiting Group.
Himanshu has received the Outstanding Young Private Banker 2010 award as a part of Private Banking International Global Wealth Awards by PBI VRL. He has also received the recognition of Most Prominent Asian Leader by City Wealth UK in 2009.
He has graduated from Shriram College of Commerce and has done his Masters in Finance and Control from Department of Financial Studies. We welcome you, sir. We thank you for joining us today out of your busy schedule and have also planted this tree on your name as a token of our gratitude. Sir, this is also trackable and we'll be sharing this certificate with you.
Right. No, thank you so much. Thank you, Smriti. Thank you, Ankur, for that kind introduction. Looking forward to a great interaction with Mridul and Ankit, and hope to add value during next few minutes to an hour with all of you, because I know entire world is getting zoomed out these days. So we'll try and live up to your expectation, make the session interesting, especially it's a difficult task since it's after a lunch. But I think we'll live up to your expectations.
Thank you, sir.
We are also privileged to welcome Mr. Ankit Agrawal, co-founder and CEO of Insurance Seco. Insurance Seco is India's fastest growing insurance platform aimed at selling insurance in a jargon-free manner to Bharat.
Ankit has over 10 years of experience across investment banking, corporate finance, business development, and general management.
Prior to Insurance Seco, Ankit was a part of Move and Sync, India's largest office commute company. Prior to Move and Sync, Ankit was an investment banker advising companies on raising growth capital, mergers and acquisition, and corporate restructuring. He worked with UBS in the US and Anand Rathi Advisors in Mumbai.
When not working, Ankit loves spending time with young entrepreneurs, advising them on various facets of entrepreneurship. Ankit is also an angel investor, having invested in multiple companies at seed and angel level. We also welcome you, sir. Thank you for agreeing to host you. We have also planted this tree on your name as a token of gratitude. We will be sharing the certificate with you, sir. Thank you so much, sir.
Thank you, Ankur. Thank you, Smriti, for the kind introduction and giving me the privilege of coming and speaking at our annual convention. Himanshu, Mridul, it's a privilege speaking on the same panel as both of you. I remember our interactions with you when I was a student, and you've always been kind to the MFC fraternity. Thank you, guys. Thank you so much.
Thank you. Now, without wasting much time, we hand over the stage to Mr. Mridul Upreti to begin the proceedings. Mr. Mridul, the stage is all yours.
Okay, thanks, Priti. Thanks, everyone. It's always nice to be back in campus, virtually though, this year, and we're trying to have this conference. So in the interest of time and also to keep it very focused, I think what I would request is during the course of this interaction, if you have any questions, please do forward them or write them or keep them on the chat box, and we will try and address them. In fact, I would encourage you to, as I was saying, ask the most difficult questions that you can, and we'll try even harder to answer some of them. So let me set the stage because we have three alums here, pretty much on the stage. So I'll go to Himanshu first, and maybe Himanshu, if you could start and take us through the times when you had just graduated. I believe it was in 1995. And what was the job scenario then, and how was, what was wealth management, during your times when you were just getting out? And then if you at the same token, if you could just fast forward today, pre-COVID, where we were, and then post-COVID, what you think we were. So I know it's a bigger question, but let's start from the beginning.
Right. No, thanks, Mridul. So you're right. I passed out in 1995. After Shriram College of Commerce, I joined Masters in Finance. And then while I was passing out, the dream used to be that if one of the foreign banks can give a job, that used to be the dream, that if MNC comes, pick you up on day 0 or day 1, you're set for life. But over a period of time, I have seen some of these dreams changing with the students I interact with. After MNCs, a lot of students, they wanted to join domestic companies and play an important role over there in terms of playing a strategy role and working closely with the management. So aspiration changed of students. And even when I come for interviews for MFC students, the ones who are appearing for joining the campus, I found one thing which is outstanding between MDI and MFC, that most of the students who are joining today aspire to become entrepreneurs. So that is how the things have changed. When I was in a school, dream used to be become an IAS or an IPS. When I was in college, dream used to be get into a finest MBA institute so that you can become an MNC banker. But those dreams have changed, becoming playing a significant role in the domestic companies, working closely with the management, and then becoming an entrepreneur. And when I see profiles like you, Mridul and Ankit, you have also become angel investors. So you're also saying, why not just go a step ahead And rather than working as an entrepreneur, I would like to nurture entrepreneurs. So that is how the landscape has changed. Coming to my own journey, 95 when I passed out, I actually joined a group called as London Forfeiting Group. Very unique, very different kind of an exposure which I got, because they just wanted to set up the base in India. And there was no office, there was no approval to set up the base. So I basically got exposed to working from home at that point in time. Meanwhile, interacting with Ministry of Finance, RBI, lawyers, so that we can get the approval to set up the base in India. After a couple of months, they shifted me to Meghraj Finance Office, where we got a room, because Meghraj Bank and London Forfeiting, in London, they used to be good friends. So there was a sort of a tie-up which happened. And my family was happy that at least I'm stepping out of the house and there's the office where I'm going to. So that is something which started. London Forfeiting was doing, it took almost 6 months before they started doing the business. But maybe as luck would have had it, in about a year's time, India became one of the high growth markets for them. I would not use the fastest growing because we started from a base of 0, but it became a high growth market for them. 97 end, we actually became a case study, and London Forfeiting, which used to have 32 offices, we became a part of their annual booklet. And our profiles were highlighted of how India has developed and evolved, and how London Forfeiting is so happy about it. I was happy that I'm doing something significant, contributing, but as luck would have had it, 98, London Forfeiting went through its rough crisis because they were the biggest lenders in Russia, and Russian crisis just happened. And as a result, out of 32 countries, 30 countries they closed down. What we became as a case study in their booklet, annual booklet, we lost the jobs. And so that was the first setback in the corporate world, where you join, you are doing well, and all of a sudden a newspaper clipping comes to you through fax in those days, not emails, that I have lost the job. And I was wondering what to do next. And I met a friend. He said there are opportunities which are coming in private banking, asset management, because mutual funds are setting up their shops. Private banking outfits are getting into wealth industry. Why not just explore this? And it was not an easy decision, because on one side you were giving $50 million, $100 million loans. On the other side, you need to target maybe 1 crore, 2 crores kind of an application. And here you need to go to clients. There was a lot of push to sell these kind of services. But again, there was no choice left. I had to apply in this industry because there were a lot of jobs which were being offered in this. So I got through DSP Merrill Lynch, where my career with private banking began. So initial 1 year I spent with them in Mumbai. And one thing which I enjoyed was the similar entrepreneurial mindset which they had. And once I could establish my feet, they also gave me the honor to go back to Delhi and set up the private clients group. So in 2000, I shifted back to Delhi, where I come from. And I spent another year with them. And 2001, I got the chance to work with Deutsche Bank. Again, one of the finest institutions who used to look after their employees very well. But it was more maintenance oriented rather than those entrepreneur oriented, because DSP and London Forfeiting were very entrepreneurial in nature. Somehow in about 15 months time, I got bored, and I really wanted to get out and do something on my own. But whomsoever you speak to, everyone used to say that you are in a cushy job, working for a great brand, you carry a card, why do you need to do this? In fact, the entire family and friends were against this decision. And somehow came February 2002, I was blessed with a baby girl on 21st Feb. And when I was in the hospital, a client called up for some work. And he realized that I am in the hospital. He asked me, everything fine? I said, yes. I shared the news with him. And the words which came out from his mouth was, "Ab to Lakshmi ghar par aa gayi hai." And he congratulated me and he says, this is excellent news. Now you can relax and spend time with the family. I will call someone else for work. And that word kept on echoing in my thoughts, mind, ears throughout that day. And that gave me that utmost confidence to step out of the comfort zone. And it was not an easy decision. So 21st February, she was born. My notice period at the bank was 3 months. 21st May, client associates came into picture, exactly 3 months later. So that Lakshmi Ghar Pe Aa Gayi gave me that himmat, that I can step out of the comfort zone. And another himmat came because I started this along with another co-founder, Rohit Sareen, who is also an MFC alumni, 95. So he's also coming on board. Both of us actually helped each other to take that bold step. Difficult decision, but if you ask me, that is one of the finest decisions which we have taken in our life. And last 18 years, it has been a journey with Client Associates where we launched the concept of a professional wealth advisory firm under the umbrella of family office. And friends, I'm pleased to share that last 18 years, we have gone through various ups and downs. In fact, as entrepreneurs, we have taken more wrong decisions, few right decisions. But today, if I look back, it's absolutely fantastic. In 18 years, the kind of a support, love which we have received. So today we work with about 700 plus families, manage over $3 billion of assets, overall a professional strength of 150. Today we are the pioneers, the first ones, the oldest and the largest multifamily office in the country, with our branches out of 7 cities. And again, working hard to attain what Ankit and Mridul have been able to attain, that become nurture entrepreneurs further. So at some point in time, once we create value, wealth for ourselves, that is something which we would like to do. So that could be the next stage. Maybe it will start in a couple of years. So that would be the next avatar which we look forward to. Coming to your last point, Mridul, on the COVID situation. Yes, COVID situation last 8 months. Practically, if you ask me, we have worked out of home. There are very few days when I have stepped out of home. I've been to office only 4 or 5 times. The office is 5 minutes away. But I have done very, very productive work. In fact, it's best of both the worlds. You are closer to your family. You're also being very productive. You have best of both the worlds. There is a lot of time, thinking time, which gives you new ideas, new ways. And there are certain strategies which have come during this period. Some of them have been implemented. We still need to see the success of that. But yes, it has been a very interesting phase. Thankfully, we are all well and are able to work from home and enjoying this phase also.
Thanks for that introduction, Himanshu. And I probably, Ankit, if you can be a little brief as well, which is when you started from college and now that you're an entrepreneur, and then Himanshu has been an older entrepreneur, let's put it that way. The process of converting, taking the decision from a full-time job to an entrepreneur, particularly that journey, and then if a brief introduction about your company and what you're trying to achieve right now.
Sure. So Mridul, I'm a 2009 batch graduate. I think the only batch in the recent memory, apart from the batch which is going to graduate now, is a batch which actually faced financial crisis, right? So I remember UBS had come to our campus. I was a day zero placed guy. UBS came to our campus, Lehman came to our campus. That was a Monday, and Tuesday morning we get up, we read on newspapers that Lehman's collapsed, right? Just imagine what we would be going through. And UBS had at that point of time picked up 6 people from our final year for full-time placement, 12 people for summer placement, and Lehman had picked up 4 people, right? And the entire DU was I think after your batch graduated, I think that was the first time that DFS had seen 2 marquee investment banks coming and offering the same package, which they would probably offer at MDI or at a FMS, right? So entire South campus was agog. We in fact had FMS guys trying to come and meet the company folks and talking to them, why are you going to DFS and why are you not coming and hiring from us, right? But overnight, the scenario changed. My joining itself had got delayed by 6 months. And that is when I started thinking, do I actually need to work for somebody or do I want to do something on my own? And that's when actually the seeds of entrepreneurship started. I am a Calcutta Marwadi. So entrepreneurship is something which is there in our DNA. For breakfast, lunch, and dinner, I have conversations of entrepreneurship with my father and brother. I started investing in stock market when I was in class 3. So that should give the group some context on where seeds for entrepreneurship were led. But that said, I think working for somebody in the initial formative years of your career do a lot of good to you, especially if you're working for a larger organization. Because one, you learn how to respect work, you learn how to respect authority. Third, you learn the value of systems and processes, right? I think working for a bank like a global bank like UBS helped me get that. Lastly, it helped me realize that there are people who are smarter than me, and it always helps not to be the smartest person in the room. Being smart is good enough, but you don't necessarily need to be the smartest person in the room. You need to hire people who are smarter than you. So these were some of the lessons which stayed with me. I came back to India in 2012 because I wanted to be around my family. Worked for 10 months with a small mid-market investment bank in Bombay, Anand Rathi. I realized after working in the US, it's very difficult to work with a semi-old Indian setup. Chose to part ways. Joined a small startup based out of Bangalore, Move and Sync. I was the third employee for them. I got decent equity, built, scaled the company. That company got acquired by Ola. I made my money, and that's when I decided now I want to work on my own. I met the founders of Car Deco. They were setting up the entire used car business. They offered me an entrepreneur role where I set up a portion of their used car business, and long term I move on to set up something on my own. And that's where we are with Insurance Deco. So at Insurance Deco, the primary focus right now is on extending distribution into real Bharat, right? In the seed or investment world, we call products or break products into the first 20 million products focused on the first 20 million users, and product focused beyond that, right? So at Insurance Deco, we are not focusing on the first 20 million users. We are focusing on people beyond that. Currently, Insurance Deco has about people in about 50 odd cities now. Sales team of about 200, 250 people. We would not be present in the Bombays or Gurgaons of the world, but we would be present in the Bhagalpurs or Hoshiarpurs of the world. The idea is how quickly can you get to a smaller tier 3, tier 4 city, help solve the problem of insurance discovery. Coming to how career aspirations for people have changed, Mridul, 2009, 2008, 2010, I can talk about these 3 years. People only wanted to work with tier 1 companies or investment banks or banks, especially if I can talk about MFC or consulting companies. But now when I talk to students, I see a sea change. There is a lot of flexibility on wanting to work with small startups, especially where they can get more hands-on experience and they get access to senior management. Second, that lure for entrepreneurship, right, is now across. Now everybody wants to be an entrepreneur, right? You go to a IIM, you go to a MDI, you go to FMS. There is that zeal in youngsters that they want to go out, build out something on their own, and I think a lot of that is because of what they read in newspapers, right? I personally believe in.
Let me just pause you there, because you talked about newspapers, and I think what you read in the newspapers nowadays is more about digital disruption. Yeah. And so we should quickly go into this topic that we are all assembled here for, is digital disruption of financial services. So let me go back to you again, Ankit, and say, describe to me let's say very briefly, how a traditional insurance business runs, distribution business, and then what does InsurTech do? What are the problem areas that you're trying to solve, and then how would one go about it?
So I think, Mridul, broadly, 2 broad areas. One is discovery. Second is de-jargonize the product, period, right? So go back 10 years ago, if your parents or you had to buy an insurance, you would have a neighborhood agent, you would send him some details, he would send you one quote, you bought the insurance, period, right? Platforms like us help solve the problem of discovery. Now you don't need to be dependent on an individual agent, or even if that individual agent works with you, he now gives you 10 options. कि मृदुल सर ये 10 चीजें हैं, आप इसमें से चूज कर लो आपको क्या buy करना है, right? Second, a lot of people who even have existing policies, right? They don't go beyond the jargons, right? So I'm assuming a lot of people here would have health insurance for them. They would not know what is copay. They would not know what is room rent capping. So platforms like us actually help you understand what you're buying and help solve for that problem, right? So democratization of the product is what we are trying to do.
And so if I were to pose the same question, Himanshu, which is in wealth management, and I distinctly remember there are, wealth management is in 2 or 3 categories. So you have the mass market, and then you have the mid market, and then you have the family offices in that space. So what has been the change, particularly digital innovation, if you were to look at the 3 segments? And is there any uniqueness? Certain segments may probably be a little bit more allergic to digitization, if I may to use the word. So happy to hear your views. You're on mute, Himanshu.
Yeah. So Mridul, I would say technology or digital has become a part of life, be it any business. But when we talk about our business and you put it across 3-4 different segments, at a mass market, there is a lot more work which is happening through technology platforms, robot advisory platforms, digital platforms. That is something which where technology will play a significant role, and human capital will play a secondary role. So primary will be played by digital, and secondary will be played by human capital. If I look at maybe an affluent segment where some of the banks are positioned, there I would say both will go hand in hand. So it will be approximately 50% digital and 50% human capital. But if I talk about maybe a segment which is higher than that, which is ultra high net worth or family offices, there technology is required to improve the efficiency, the algorithms, the artificial intelligence or the machine learning which comes from there, and productivity of people can improve. But human capital will still play a 75% role over there. So again, the segment which we cater to is family offices, which is typically 100 crores plus kind of families. Their technology is a great enabler, but it cannot replace the human capital. But human capital needs to adapt and become more comfortable with use technology so as to become more valuable and productive for themselves as well as for the clients itself. So that is what yeah.
Sorry. If I understood this correctly, there is an echo. I think somebody is not on mute. So if I understood this correctly, there is a segment which is getting disrupted, and there is another segment which is getting more tech-enabled because of technology. And do you see any changes pre-COVID and post-COVID in different segments, particularly the top segment?
So I would say at the top segment, which is high net worth, ultra high net worth families, their technology is becoming a great enabler. But technology, can it replace the human capital? Especially when one is talking about handling few crores of wealth. It's very difficult. I have seen, Mridul, in my own journey, the moment client accumulates more than 10 crores, their time allocation and seriousness towards their own wealth goes up significantly higher. The moment they are 100 crores plus, it's even much higher. So though technology, they would like the information to come, but for analysis and counseling, they would still need an advisor over there. So human capital cannot be replaced over there. So the way we look at our space, which is high net worth, ultra high net worth, there are 3 or 4 elements of technology which plays over there. One is reporting, where consolidated report comes so that every advisor as well as clients can see what is the overall picture looking like. Second is technology can play some role in terms of giving some more intelligence about various asset classes and products, which is where primarily our research teams are dependent on. And they use that technology analytics information to analyze the things. Third is in terms of operations. Earlier, the thing used to be everyone used to sign checks, forms, everything used to be physical. Especially during COVID times, we felt that clients who wanted to transact, some of them were stuck who were not working on technology because there was a lockdown. And even you wanted to send the forms, people were not accepting physical forms while technology forms were getting accepted. So it forced people to get onto the technology platform for operations. So today, if you ask me, reporting, everything is technology. Analysis, a lot of it is on technology. Operations, it's practically everything on technology. But advisory, where human capital or softer skills are required, that technology has not taken place. There still human capital is required, and I feel that would be required throughout with the ultra high net worth segment.
Okay, so probably let's pause that thought and let me take the same thought to Ankit. So Ankit, in insurance, if for the benefit of everybody on the call, if you look at a traditional insurance company, it's basically writing premiums, and then it's creating a product, and then it is distributing that product, which is the insurance product, and then it is administrating it, which is a policy after that. And so Ankit, if the same question, if I were to ask to you, have you seen, complete disruption, or is it getting more tech enabled in your industry? Okay, I think Ankit has dropped off. Ankit? Okay, maybe he's dropped off. So
this is the disadvantage. This is the disadvantage of technology.
Technology.
Yeah. So sometimes you are dependent.
Yeah. So yes, there is a connectivity issue. He'll join back.
Sure. So let me go back. I don't want to do a monologue, Himanshu. Maybe a dialogue with you in the interim. So if that is to be true, how do you think the operating model of a wealth management firm? How do you think that is getting?
So again, India is a huge market with 130, 140 crore people. Let's say 10% of these have the capability to invest their money. Still, it's a huge market. And I would say 90% of them will fall into the bottom of the pyramid. Bottom of the pyramid, their technology can really play a very, very significant role in terms of reaching out, in terms of managing that market, in terms of sharing knowledge with them, all those things. Because 90% of 13 crores is roughly about 11, 12 crores people. That is where technology can play a significant role, majority role, where there could be a lesser role for the human capital. But then comes the mid segment, which is, let's say, another 9% market, which could be dominated by banks. And banks have to today give apps to their clients, try and do everything to technology, whether it's sharing information or transacting. Technology will play a very, very significant role. Even 1% where family offices comes into picture, which is catering to the absolutely uppermost end of the society. Technology will play a very significant role. Technology will play a very significant role. In fact, today, everyone, so when we say 3 T's, which is what client associates is associated with: trust, talent, transparency. Someone said, should we also look at technology and make it 4 T's? They said, no, T is actually a part of each and every outfit, every organization. You just see, Mridul, the kind of investments which are happening, any round of funding, which is $5 million upwards, last 2 years, 70% of that has gone into digital platforms. Now, even various promoters who are running traditional businesses may have a very traditional way of investing their money into property, into their own businesses. But today they are allocating a part of the portfolio where they want to go and invest into technology businesses, because that is what is disrupting the market. So just to give you a sense, last year India produced 18 billionaires. 18 billionaires, which means every 3 weeks or every 20 days, there is a new billionaire which is added in our society. Out of 18 billionaires, 17 came from tech platforms.
So sorry to interrupt.
Okay.
Panel.
Yeah, sure.
So 17 came from technology platforms. 7 of them came from Bangalore city, which is known for technology. Similarly, there were 120 ultra high net worth, which were added, which means every month, 10, every 3 days, 1. And ultra high net worth is $35 billion upwards. A lot of it is happening because of the boom in technology or digital platforms. which is enabling people to create a lot more wealth. And that's the reason I'm not surprised when I visit MFC or MDI. Youngsters these days, when they want to join the institution, their aspiration is 2-3 साल का experience लेंगे job का, and then we want to become entrepreneurs. So we want to pick up the skill sets which these institutes can offer us so that we can become better entrepreneurs over a period of time.
So I just take increase the discussion from a different perspective. So we've looked at the client side. Now let's look at the operational side. So for example, most of us on this call would be aware of trading platforms which have now completely gone online completely, and there are a few examples which are famously quoted. They're revenue funded, they've not even raised capital, and they're still growing. And when you look at the US, there are a lot of similar examples. So you see Coinbase, Robinhood. In India, you see Zerodha and other companies which are there. So what's your view on certain segments of this service, which you were mentioning before also, I believe, becoming completely digitized, irrespective of the segment of client base? So for example, trading in equity stocks and commodities across the table.
Right. So I would say quite a number of these platforms like Zerodha has become a huge success in a short span of time. There is another one, Endwealth, which has also raised huge amount of capital. I do not know whether it has still become a success story or not, but they have demonstrated success in raising capital, which means there is a money which is chasing these kind of opportunities. And there is a hypothesis that if money is chasing, that means there will be a demand for these kind of services and there will be a value creation and these kind of things. But having said that, US is slightly ahead in number of years as far as these kind of platforms are concerned. There are a lot of fintech platforms which have come. I would say most of those platforms, they have done phenomenally well at the, again, retail market, affluent market, but towards the higher end, they have not been able to replace the human capital. Still, an advisor is required, because if you ask me, managing wealth, that is second closest thing to anyone's heart. First is their health, which is the most important that they should live. And Indian society, which is very conservative, wealth is very, very close to their heart. They cannot enable or see maybe a couple of crores to be invested through a technology platform and they are dealing with a call center or a robot advisory kind of a model. They need a voice, a advisor on the other side who can handhold them during various phases of their life or various phases of investment cycle.
Sure. I'll go back to Ankit. Ankit, are you there?
Yeah, Mridul, I'm there.
Okay, good to have you back again. So I was about to ask the question, and before you dropped off, and maybe I'll repeat it again briefly, is we see insurance, which is basically manufacturing of the product, which is one side. The second side is the distribution of the product, which is what your startup is into. And then the last point is the administrating of the policy post the distribution. So how much of it now you would see is completely digitized? And is there a full stack opportunity across the three, or which is horizontally, which is you start from manufacturing, distribution, and administrating, or is the opportunity on the vertical stack where you look at either distributing only or manufacturing and so on and so forth? So it'll be good. And also then maybe after that, briefly, we'll touch upon unit economics and how do you measure them in such businesses.
Mridul, you actually remind me of my board discussion, which I just had last week. The same questions I answered last week. So let's first talk about the entire ecosystem, right? So as you correctly put it, it's manufacturing, distribution, and servicing. India, unfortunately, even though we have two companies now in Echo and Digit, who actually call themselves new age insurtech startups, but none of them do end-to-end manufacturing in an automated fashion, similar to what Ping An or Zhong'an do in China or Hippo does in the US, right? So globally, you will have lots of examples where complete underwriting or manufacturing has moved to an automated algorithm-based system, right? With some minor individual touches, right? So tech has become primary there. Manual intervention has become secondary. In India, I think we are at least 5 years behind. 5 to 8 years behind that zone because the entire underwriting models at our end, right, are still based on some actuarial calculations which were done about 2 decades ago, right? So that's on the manufacturing side. On the distribution side, I think we've seen a lot of evolution happening. 3 years back when I started out Insurance Eco, a lot of companies did not even have APIs, right? But now everybody has APIs. Everybody's realized the power of distribution through technology. And distribution, I think, is in a fast track zone to move to complete digitization. By complete, I mean by India standards, we are at 5% right now. 5% of total business source is digitally sourced. That would probably go to 10 or 15% in the next 5 years, right? So this industry entirely doubles. On the retention or servicing side, which you refer, so there are a couple of old or relatively older insurance companies backed by good, strong promoters like HDFC, Argos of the world. They've taken a lot of steps on completely digitizing this process because they realize that the unit economics of this business is only going to work if they spend dollars more on getting the right business and sourcing the right business, right? So digitization in the third aspect has started happening in a rapid fashion, and I think about 50 to 60% of back office functions for a lot of large insurance companies and a lot of large distributors, right, have got digitized, and new age technology like have actually helped us. Where we are lacking here is in claim settlement. So I think there is a lot of work which will have to be done on the claim settlement side, because you automate that part, then you substantially cut down a lot of cost there, and you will have to solve for it in a correct fashion, because at the end of the day, you want a happy customer.
So let's deep dive and hold the thought there and deep dive further for the benefit of everybody.
Sure.
Most of the audience here is students and doing various courses.
Yeah.
So it'll be nice to start from a simple definition of what do you mean by unit economics? Yeah. And then when I'm doing MBA and finance and I value things based on DCF, yeah, how do I value startups where seemingly upfront there is no revenue or there is no numbers to really DCF, right? So, yeah, so maybe starts with let's do unit economics for InsurTech and see if there are any questions around it. But you know, please start.
Sure. So fortunately or unfortunately, in the world of startups, I myself have raised about $300 to $500 million. I took LinkedIn public. I have not, in a private equity funding, especially at a Series A, B, C stage, we've not done DCF. We still look at revenue multiples or EBITDA multiples, probably on a 3-year or a 5-year forward basis, right? So let's look at Insurance Eco. Why look at something else, right? So for me, I would probably start with revenue. Every 100 rupees that I'm making right now, what is my ability to save money at EBITDA level, right? So we sometimes call it CM4, wherein we don't include BU fixed cost, or if I include BU fixed cost, I would say EBITDA, right?
Sorry, let me stop you there, because I know people are going to ask questions.
Sure.
So there is something known as GMV,
yeah,
which is gross merchandise value, or whatever you call it. Then there is the net brokerage or revenue that you earn, right? That is your net revenue. And then there is a cost associated, the variable cost associated with delivering that revenue. And then the reference that Ankit is making is CM, which is contribution margin. There is a contribution margin 1, contribution margin 2, 3, 4. Yeah. Ankit has reached 4 stage, but normally I think we would look at 1 or 2 stages. So let's start from there and sure, probably go ahead. Yeah.
Sure. So Mridul, in insurance, we would not look at GMV because there is no sourcing or selling of goods, which I would do. But yeah, we would look at GMV in the form of brokerage, which we make, right? So if I'm selling insurance products worth 100 rupees, I would make anywhere between 15 to 25 rupees, depending on the type of product that I'm selling. So 15 rupees here would be my revenue, right? From there, I would look at my variable cost. That is cost which I have to fund my sales, cost which I have to fund my internet, office expenses, etc. Here in internet companies, typically, especially in the distribution side, we would refer to BU fixed costs in 2 parts, which would be our fixed manpower, that is management or spending in technology and product. Everything else for us is fungible or variable. Tech and product and management is the only fixed cost we have. So for every 100 rupees that I would make in terms of revenue, I would want to limit my CM1 and CM2 at anywhere between 30 to 40% in an ideal scenario, right? Because I would want to, for every dollar that I'm earning, I would want to spend at least 40% of that dollar in long-term value creation for me. So at CM1, CM2, I would come down to about 60 rupees from what I have made. At CM3, 4 level, I would want to spend about 30 to 40 rupees, and I would want to have 20 rupees at a EBITDA level. Hope this answers your question. Happy to answer it further.
Sure. No, I agree, and I'm going to ask Himanshu a similar question, but and try then see if there is a midway. But for the benefit of the audience, these are proxies of net income, right? So because I know everybody is finance oriented here, most of the students. So if you don't find cash flow at net income level, you go a little higher, and then if you don't find it there, then you go a little higher. And then when you reach a CM4 or a CM3 or a CM1, and then if you don't find it there, you reach top level, which is revenue. By the way, if you don't find it there in startups, then you're basically dealing with a content or media company where there is no revenue, but there is a lot of attention, right? Which is active users, as they call it. So let's pause that thought and let me go and ask Himanshu pretty much a similar question in terms of valuation of startups. And I'm sure there are a lot of family offices and a lot of clients who look at investing in startups. And so Himanshu, how does this work out in a client portfolio, this asset class called startups? And then what kind of advice do you give in clients when to enter and probably the risk around this thing, particularly in fintech startups?
Right. So Mridul, we look at a very holistic approach in terms of what should be the overall asset allocation for clients. It again is very customized depending on each and every client's profile, but just to give you a ballpark idea, the way our clients invest their money, 50% goes into public markets. About 25% goes into fixed income. Then there is some money which they like to invest in property besides their own home. Home we don't consider as a part of their overall wealth. But what is left for alternate asset classes is roughly about 15%. Alternate would include startups. Alternate would include growth businesses, but unlisted businesses in private equity. Alternate would include alternate markets, which could be outside India. Alternate could include maybe hedge funds or strategies which are working around hedges. But my sense is kitty which is kept for alternates is moving towards startups and growth capital in the private equity space. There are various ways in which they go about it. Some like to go with certain funds, recognized funds, and say, okay, fine, we don't have the bandwidth, we don't have the team, we don't have the know-how about how the space functions. So let's just piggyback on some of the best managers and diversify across 2-3 managers over there, which is an ideal way up to a certain size of the portfolio. But if your portfolio of this 15% is running into a couple of 100 crores, then some of them, they also like to set up their own teams and write a thesis. And I have seen most of those investments are happening in fintech platforms only or technology oriented platforms. Like we have clients who have invested, in fact, last 4 years, a lot of them have invested in a company similar to Ankit's, Policybazaar. We entered over there 4 years back, 3 years back, 2 years back. And right now, maybe clients are still holding because they still feel there is an opportunity in a space like this. So it depends. We curate certain transactions. One thing which we are very, very particular is because for us, investment into Policybazaar or any such thing could be 1% of the balance sheet. But my 99% association is held with them. So we have to be extremely mindful. Though we are taking the risk, but the risk is well judged, well thought through, well researched, where we can put our own money. That is something which we will recommend to those kind of clients. So I would say space is offering huge opportunities. There is a risk element which is associated with it. A lot of people who say investment into unlisted space is an art, they are going wrong. You have to back it up with science. And if you back it up with science, there is a higher probability of success. There is nothing, because if that is the case, entire money will move into those things. But there is a higher probability over there. And so I hope that answers what you were looking at, or is there anything specific you want me to touch upon?
No, that answers what we're looking for, and I think we are pretty much in the last 10 minutes of our conversation. So maybe one last round of questions. If there are any questions that you would like to ask, please post it on the chat, and I'll read it out to our panelists. So maybe last question, Ankit, and then we get into Q&A, is career advice, right? Career advice if you're graduating this year, when it is very similar to 2008, 2009. So if you were graduating this year, how would you have played it differently, or would you do the same thing? And then briefly, if you are doing the same thing, then how would you do it differently, right? So maybe in that order.
So Mridul, two things here. One, I don't think I would do the same thing. What I did when I graduated in 2009, I waited for 6 months to join UBS. Now I would not do that. What I would do is I would try reaching out to the numerous founders across the country and try to get experience in a startup, work in a very, very fast-paced environment, try to get to scale quickly, scale quickly, because the markets now started opening up, right? So career advice to everybody here, don't look for a job in a big organization. Look for a job in an organization where you can get lots of learning. So a lot of my batchmates had joined client associates, and I saw them learning, right? I saw them learning. My seniors had joined client associates. A lot of my batchmates had joined your team, Mridul. JLL at that point of time was a relatively smaller organization, even though it was a nationally renowned organization. I saw the steep learning curve which they had, right? So one big piece of advice to people is don't chase brands, chase companies where you know, or chase profiles where you know you will be able to add significant value to yourselves in the next 18 to 24 months. That is very, very important. Second, now social media is all around you. Try to do research on the manager with whom you will be working. That is very, very important, because a good manager can actually change the course of your career. That is the first two pieces of advice. The third advice to everybody is India is changing. Please think about starting your own company or becoming an entrepreneur. It always helps being an employment creator rather than asking for employment. These are the three pieces of advice.
So those are very valid points, and maybe Himanshu, a few points from you. If I were to apply to client associates today and I've just graduated, what skills should I have and compared to 10 years ago?
So Mridul, you are most welcome. In fact, it will add huge value if someone like you come and join client associates. But I will say most of the things which Ankit has mentioned, I will go with those. I will say go for a career move rather than a job move. Go for a place where you can make a difference. So something where you can be a part of the decision-making process, or you can do something which can be noticed, because otherwise bigger organizations, they are like an ocean. You're compartmentalized into something, and then you keep on focusing on that. Go to a place where there's more holistic learning, so that you learn different aspects of business. That is very, very important. And one thing which Ankit mentioned, I think people work for people. People don't work for organizations. So look for a great team, great manager. That is something which can make a huge difference to your life. And I have seen most of the case studies during my 25 years of tenure. Frankly, most of these case studies have come in those cases where people have learned a lot by working for people rather than working for brands.
Sure, thanks a lot. And I think we have time for maybe 2-3 questions. So I'll read them out to you. And maybe the first question, Ankit, is to you, is how can we, this is from Rohit Ranjan, is how can we transfer the traditional insurance product, which are generally for hedging the risk, into an investment product, right? So how do you make sure that something which is basically risk management also becomes an investment management? And I should add, actually, Rohit, previous attempts of creating ULIPs out of this have not been very successful, but Ankit, your answer to this
So,
question.
Mridul, I think the problem in India is twofold. So, I think this is more from a life insurance perspective. India has traditionally been an endowment heavy market for life insurance. It's not been a term heavy market, right? So, that is where people started looking at hedging their risk as well as getting some returns from their money, right? But if you go back to the US, people wherever they take, I think term is a bigger market in the US. Pension products are more like publicly controlled, public organization driven markets, and there is greater affinity in individuals, right, to invest in the market. So I think it's a part of process of learning or awakening, financial awakening of people as more and more money moves into public markets, which our government is now trying to do. More money moves away from fixed deposits and start getting into public markets. More and more people will start looking at insurance not only as a risk product, risk coverage product, but also as an investment product. But if you ask me as an insurance advisor, I will never ask you to mix the two. I will always tell you that use a product for the means which protection with investment. You should look at insurance as a means to protect yourself or protect your generations to come, right? That is one person below you or your son or daughter or your wife. That is my advice.
Sure, thanks. And the next series of questions, Himanshu, if I can ask them to you, these are related to how is robo-advisory, and then how should professionals skill themselves up to face the brunt of robo-advisors changing wealth management as an industry? And maybe I'll stop there and take your views.
Yeah, so I would say robo advisory definitely will play a very, very significant role with people becoming more and more comfortable with technology, the younger generation, affluent segment. Robo advisory will play a significant role. But I would say over there also, to think that they can make money from the product level itself. But at the product level, if you're not making money, I do not know how that business is sustainable. So a lot of organizations, they come in the valuation game and they say, okay, fine, we will spend this much, we'll show this kind of a scale, we'll show this kind of losses, we'll take more capital, more capital. I do not know if you have seen this movie Upstart, and that is just about entrepreneurship. There are some models which have come on that basis also, and they've approached us, they wanted to raise capital, but we don't feel comfortable over there. But if at the product level you are making profits, at the corporate level you are still not making profits, but there is a hope once the scale is reached, at the corporate level you are able to make profits. Those are the businesses which will succeed. So business has to be done with a sense. Business has to be done with the numbers in mind. Business has to be done with profit and loss, keeping that in mind. If there is a ray of hope of building a scale, and then at the corporate level, you're able to make profits, those models will succeed exceedingly well. And India is a huge, huge market for that kind of a space over there.
Sure. I have time for one more question, which is about, Ankit, maybe back to you, which is about impact of devices in insurance. So, you know, when you're having smart sensors and devices and you have IoT capturing data, then how does it fundamentally change the insurance business?
I think, Mridul, this is a given in Western countries. This is a given in Europe. In India, this is a new innovation. So a couple of companies like that have come up with products. I think there's a lot of disturbance in the background.
Can I request everybody to please put themselves on mute, please?
Yeah. So yes, I think a couple of, so IRDA, which is the apex body for insurance in the country, has recently taken a lot of approaches to allow innovation in the industry. We've, in the motor segment, we've gone live with pay-as-you-go or IoT-based insurance policies. In health, a lot of insurance companies have now come up with variable linked insurance policies, where the more you exercise, the higher discount you get in your premium. I think these changes or adaptations in distribution are going to hold good for the industry, because people will now be able to choose and underwrite business which they consider profitable. And ultimately, if they make money, the company becomes profitable, similar to what Himanshu was saying. And Himanshu will be able to advise his clients in investing in them, and hence distributors like us. So hopefully soon Himanshu says that he's advised his clients to invest in us also.
Oh, sure. And I think we've run out of time. So pleasure, gentlemen. Ankit, Himanshu, thank you so much. If there was a virtual way of having an applause, I would request you to unmute yourself and give an applause to everybody. But thank you so much. And back to the coordinator.
I will also like to thank the esteemed panel members for their contribution of time today. It was really an enlightening discussion. I would like to request Mridul Upreti sir to stay back for the next session.
Sure. Thank you.
Thank you so much. Thank you, Mridul. Thank you, Ankit. Thank you, everyone.
Nice to see you, Ankit. Seen you after a long time.
Pleasure's all mine, sir. Thank you.
Himanshu also.
Thank you, sir. It's always a pleasure to see you. Today, whatever we are, we have achieved. It's, I think, a lot of credit goes to you because of your teaching, because of your knowledge.
It's all your effort and commitment to the work that you're doing. I'm so proud that we see. I know you, of course, as a teacher, and of course, as a supporting. You have been supporting our campus. In fact, all the three, Mridul, Ankit, and you have helped our campus so much. And we wish that everyone has this same amount of sense of belonging for the institution. I think I'm very happy to see you once again, all of you.
Thank you, sir.
Thank you.
Pleasure.
Thank
you.
Yeah, Ankit and Himanshu, I'll also thank you on behalf of the department. Hello.
Right, Dr. Sir. Yes, Dr. Sir.
You can't see me because I'm not in my formal, so it's better to be away. But we'll be soon getting back to you, Himanshu, as well as Ankit and Mridul, of course, for the incubator we are planning at our department. But this is not the stage to discuss right now. Maybe sometime next week.
Sure, sir.
Okay, Dr. Sehgal.
Yeah.
Thank you
so much.
Thank you, sir. Thank you, Professor.
Thank you, sir. Bye-bye. Bye-bye.
You want me to start, or would you introduce everybody again? Next panel.
Yes, sir. We will be introducing the next panel. Just
So I don't know if everybody is there, but Professor Rana, I can see you. So good to see you. Then, hi, how are you? Hi, John.
Hey, Mridul, how are you?
Hi, good to see you.
hello,
I don't know if
I am here,
Ankur is here. Hi.
hello, sir.
I think, sir, everybody is here. We can start.
I'll start just. All right. I request all the attendees to make sure that you're muted. And ladies and gentlemen, we will now begin with our second panel discussion of the day, that is Fireside. The topic for this Fireside chat is role of technology in real estate. Now, I would like to invite your attention to the screens to understand the key issues to be discussed with this panel. We are privileged to have with us Ms. Inu Rana.
Ms. Inu Rana is an accomplished senior business analyst of the Launchpad Innovation Program at the Western Sydney University, Australia. Her work portfolio ranges from managing businesses, supporting businesses, advising startups, and working with manufacturing industry in Greater Western Sydney region. in NSW, Australia.
Launchpad is a tech business incubator and has a range of startups that it facilitates and hosts. Inu is very passionate about entrepreneurship and immensely enjoys helping startups realize their aspirations and potential. Prior to moving to Australia, she was involved with the family business of pharmaceuticals in Delhi and continues to serve on the board.
She has served on the panel of National Productivity Council of India. She has spoken at seminars internationally and has been recognized for her practical no-fuss approach.
She has worked across the South Asian region with top MNCs and industries and has a strong interest in innovation, hoping to contribute further to the wider development and advancement of the business sector in the Western Sydney region and beyond through her work and research. We welcome you, ma'am. We have planted a tree on your name as a token of gratitude, ma'am. You will find it on your screen and it will be shared with you on mail.
Thank you very much for the introduction and thank you for having me, Sanjay sir and Mridul.
The second panelist is Mr. Ankur Srivastava. He is chairman at General Property Advisors. In his previous corporate role, he was managing partner at Prosperitas Capital Partners. He has also worked at DTZ Debenham Tyle Young as founding managing director and country head, and with JLL Capital Markets Group.
Mr. Ankur Srivastava is an alumnus of MFC. He has experience of more than 20 years, with his specialities in Indian real estate, structured finance solutions for distressed real estate, including refinancing of non-performing assets, real estate sale and leaseback, industrial real estate and warehousing, REIT portfolio structuring and advisory. We welcome you, sir, and with a small token of gratitude, we have planted a tree on your behalf as well.
Thank you. Thanks a lot, team. Always a pleasure to get back to the campus and always brings back a sense of nostalgia. I'm looking forward to the conversation. Thank you.
The third panelist and the moderator for this fireside chat is Mr. Mridul Upreti, who will be joining us in this session as well. We welcome you, sir. We have planted a tree on your behalf as a token of gratitude.
So I get 2 trees, right?
Yes, sir.
Okay, thank you.
Our fourth panelist is Mr. John Kuruvilla, Chief Mentor at Brigade REAP. He has a diverse set of experiences, having worked in marketing, sales, brand building, customer relations, revenue management, pricing, general management, P&L responsibility, and entrepreneurship, making significant contributions to every brand he has been associated with. He has also been awarded a Cannes in 2000 for advertising.
Mr. John has led investment in several disruptive companies from India and abroad, and also set up an accelerator program at Reliance Industries. John is also the founder at Brigade REAP, Asia's first PropTech focus accelerator, and continues to follow his passion of working with startups. We welcome you, sir. We have planted a tree on behalf as a token of your gratitude.
Thank you, Ganesh. Thank you, Riju. Thank you so much. Look forward.
Now, without further ado, now I request Mr. Mridul Upreti to take over and kindly begin the proceedings of this session.
Okay, thanks. Thanks, everyone. It's always nice to be moderating one of these again, and welcome to all the panelists. If it's okay with you, we'll probably extend this by maybe 8 to 10 minutes so that we get all the 4 panelists or all 3 of us or 4 of us to speak. So before I begin, I believe, John, and to set the context of PropTech is a fairly new, fancy word, but it is now gaining traction across the world. I think there seems to be an interesting thought process around what is PropTech? What do you classify as PropTech? Is it a level of service only, or is it devices? In my very broad definition, and I'll start with there and hand it over to John, it's basically a device or a service that either reduces cost or brings a revenue in terms of a project or an operation. And you can pretty much capture 90–95% of the market, PropTech market in that sense. So in this panel, we have 2 incubators, Professor Rana in Australia, late evening for you. How is your incubator doing? I think that would be a great segue also after John. and John, of course. And then Ankur and I have been from the traditional side, so probably we'll chip in there. So starting with you, John, if you could just begin.
Thank you, Mridul. Thank you, Dr. Kumar. Thank you, Dr. Saigal, for having me share our journey. What I'm going to present comes from a deep understanding of the challenges and issues facing the real estate industry. Now, we know that verticals like fintech, food tech, ed tech, health tech have been there around, and this is what the journey of many young aspiring entrepreneurs are. But today, I'd like to build a case as to how the young minds that are sitting as participants need to evaluate a category that's actually solving real problems. So I set up REAP in 2016. It was Asia's first PropTech accelerator. The word PropTech was coined by us. There was not a single company in Asia which was doing what we were doing. And people told me that, look, I mean, you're chasing a wild goose dream. But from an early day of my life, I've been chasing dreams only, because real estate companies were not looking at adopting technology, and there were only a handful of technology startups solving these challenges. If you look at real estate, there are significant challenges facing the industry globally. And there's a McKinsey report which says that 20% of projects across the world are over budget and 80% are delayed. Coupled with the fact that labor productivity in the construction sector is the lowest globally. Now, India is no different. The India challenge is significantly higher because the construction labor productivity is the second lowest after gems and jewelry. And Indian real estate companies, the big ones that you know of, invest just less than 1% of their revenue towards technology. And this technology is primarily into SAP, the ERP systems, the CRM, and the Salesforce. And 95% of the workforce sits outside the corporate office. They don't have technology which is worth their while. If you juxtapose this to the size of the real estate industry in India, 13% of our country's GDP, second highest employment generator, urbanization is going through the roof. In the next 10 years, almost 50% of people are going to move into urban cities. This is going to add a huge stress to our own lives going forward. If I tell you that the challenges facing the real estate industry is nothing compared to the challenges facing each one of us on this panel discussion, 39% of all global CO2 emissions are from buildings. 35% of all waste generation is in buildings. 30% of energy costs are wasted in buildings. 20% of all water consumption is in building. And those of you living in Delhi know very, very well that indoor air quality is bad. But did you know that indoor air quality is 5x worse than outdoor air quality? And in today's COVID era, we spend more than 95% of our time indoor. All this is challenges that the world needs to grapple with. If you look at water, 54% of India faces high to extreme water crisis. 21 cities in the next 5 years will run out of groundwater. What's fascinating for the people on this panel and the participants is that Chennai, which is surrounded by ocean on two sides, has run out of groundwater. Sewage problem. The picture that I'm showing you are picture of lakes in Bangalore burning. Lakes in Bangalore. People living near these lakes have got severe health crisis. And this is true of across the country. 77% of Indian sewage is untreated. 40% of Bangalore sewage goes to lakes. And conventional STPs don't function half the time because there's not enough power in many cities in our country. I'll just cap this with one statement. In the next 10 years, our country will need landfills the size of Bangalore every 10 years, which means in the next 50 years, there will be 5 large cities which will just be landfills. This is not a movie seen out of the future. This is a reality, and we are seeing this in Bombay, we are seeing this in Delhi, we are seeing this in Bangalore. Air, 1.2 million lives over the past 5 years were lost due to toxic air. And there is a danger that we are not even aware of. All of us use Wi-Fi, we use mobile devices. The EMR radiation that is in your homes, that is in your offices, is 1,600 times in many cases higher than what the WHO permits. In fact, the office that I was sitting in, the corner that I was sitting in was 1,650x the time the permissible limit. And I didn't even know it. I had mild headaches and I used to feel tired till we did an audit and that told us that this is the danger. And with 5G coming in, it's going to get worse because cell tower densities are going to go through the roof. Our cities are becoming unlivable. In 1973, almost 70% of Bangalore was green. You know, in 2020, 93% is red. How can we survive in such an environment? And this has significant impact on the real estate industry. And our industry, which has been reeling from one tsunami after the other, GST, RERA, demonetization, COVID, is going to now face severe financial crisis. In just the last 15 years, 64% is the change in temperature in Bangalore. For every degree of temperature change, there is a 4% increase in OPEX. 32% is the depletion of groundwater resources, resulting in a 30% increase in annual water costs. And 7% is the increase in waste management costs annually. 15 years, the real estate industry in Bangalore is suffering every 15 years a loss of $2.3 billion. Now just extrapolate this to 20 cities in India and you're sitting on problems of gargantuan proportions. And our problem is not technology, it's primarily a mindset and behavior in this industry. The sectors that PropTech defines is construction tech, collaborative economy, smart, and the cusp of fintech. But after having spent 4 years in PropTech, you realize sustainability, and this is what Pradhu you alluded to, alternate energy, big data, alternate materials, asset management, legal tech, wellness, all encompass PropTech. And because this is deep tech, we've got into partnerships with the like of Cisco, Intel, AWS, and Microsoft and CBRE. Our selection process into this program is very, very stringent. Out of 2,000 startups that we've evaluated, we've only onboarded 44 startups. And the picture you see on the right are eminent jury members who come year after year because they've realized the importance of PropTech and they help us select people. We have Vani Kola from Kalari Capital, we have Vipul Rungta, MD of HDFC Capital, Ram Chandani, MD of CBRE, we have the founding team of Zoho, we have Samir, MD of Inventors. They've seen the value of PropTech in solving real issues. These are some of the startups that we have mentored. All of them are doing exceptionally well. And I bucket into 3 buckets. The first bucket is in green. These are startups solving the sustainability issues, the issues that I raised. The blue are companies that are solving inefficiencies in real estate. And the red are the ones that are solving COVID issues. So there is a problem in the industry. We go out and find solutions that actually address these issues. And there are data. So we are completely data centric. You know, Smarter Dharma has created 1.5 million square feet of sustainable spaces. EcoSTP has processed 100,000 kiloliters of wastewater and saved 150 megawatts of power. It's equivalent to lighting up 20 villages in India. VGOT has saved 3 billion liters of water. Snapshoot has designed 2.5 million square feet using a technology that's going to disrupt AutoCAD. QuickSpec has 700 million data points, 3 million deliveries done by Express. I'm going to just give you all a flavor of the startups. Cleco is cleaning every month 1.5 million square feet of air. A lot of it is in Delhi. And Pothole Raja has made 600 kilometers of roads in India pothole free. So to all the young minds on this discussion, look at this sector seriously. We are very, very data centric. 42% of our startups have raised funding within a year of graduating. Every year, because we're helping build sustainable, scalable companies, 150% is the increase. The startups are valued today at 100 million, and 8 startups have raised money in COVID times. 1,000 employment, taking many of these startups global now through our partnerships. Just as data points, as alternate career opportunities, I heard Ankit and Himanshu talk about, look at great startups, ladies and gentlemen, you want to make a difference, this is the sector that is beckoning young, bright, adventurous minds. These companies, when they came to us, had monthly cumulative revenues of $100,000. Within a year, it had moved 6x to $620,000. They came to us with valuations of $5 million. Today, these 10 companies are valued at $45 million. And prop tech startups today are sweeping award after award. Business Today's 12 coolest startups are 3 of our startups. KPMG's Global Innovation Report has every year 2 of our startups featured. NASSCOM, CBRE, DisruptTech, the top 3 were won by us. JLL, we got 1. Forbes Under 30, you have Cleco. And last month, the Government of India recognized Brigade REAP as the Accelerator program as the #1 company in this country. So all of you, do join us in this revolution that is real, that's solving real problems, without which our lives and the lives of generations after us will be mired in misery. Thank you, Mridul.
Yeah, thank you, John. That was very insightful. In fact, I should also mention that I had the opportunity to look at one of the startups in your cohort called SnapTruth as an angel investor, which unfortunately I missed investing in. But here was a startup which was trying to disrupt the way design of a building is done from scratch, and probably taking on the big Adobes of the market and trying to disrupt that. So
I just want to add a thought for your young minds there. When Altaf came to us, he was 22 years old.
Altaf is the CEO of
CEO of SnapTruth. 22 years old, 10 international papers published, and he came and met me and said, you know, sir, I want to disrupt AutoCAD. All I did was hug him and tell him, come tell me your story. Today, he is building his company. He's raised close to $1 million, raising another $5 million. And every investor in the US is asking him to come and set up his business in the US. So these are young minds. So all the young minds there, take Altaf's journey as an inspiration.
Yeah, no, sure. I think it should be okay for everybody to go and Google Altaf Galihar, I think. And I should say, I say it publicly, I missed investing on that round. But anyways, starting the discussions, you know, Professor Rana, you also run an incubator, and which is Western Sydney, and you know, briefly, if you could describe your focus areas in prop tech, and then before we start the discussion.
Sure. Look, I'll take us a step back. So our business incubator, which is called Launchpad, is part of Western Sydney University. So we're based in Western Sydney region, which is one of the biggest regions in the state that we are in, New South Wales. Now, we work with industry very closely to sort of, you know, bring innovation to industries. So that's where PropTech comes in for us. So there are a few sectors that we are focused on. Advanced manufacturing is one. PropTech very recently added, and when I say recent, it's been 2 years now. Then we have a lot of EdTech, we have a lot of professional services and those sort of, you know, technologies, and gaming is another sector that we are very interested in. So now what we are seeing in Australia is that traditionally construction or property was a very sort of, you know, off technology and traditional sort of a business, so more brick and mortar. But we're seeing a rapid, you know, technology transformation in this industry. As you said, you know, it's a fairly new term, even for Australia it is. And a lot of changes are happening in the consumer mindset and in overall development of technology, which is bringing transformation into this traditional industry, as I believe. As John mentioned, you know, it is largely has been driven out of the greater inefficiencies in the system that are still existing, and we are still working on it. And another focus area is sustainability. So we see that a lot as well. We work with Lancom, which is our state developer. We ran a PropTech accelerator. We run these short industry accelerator programs, ranging from 3 to 6 to 9 months, depending upon what industry it is. So we ran PropTech last year. And we ran a very small cohort, and it was in partnership with Lancom, as I said, the state developer. And the sort of startups that we helped were, you know, they were responding to the sort design and construction, sales, and 1 or 2 on leasing, and a few on energy efficiency. So these are the areas that we are also seeing in Australia, and the changes where we are seeing. We're also seeing a lot of specialized tech uptake in this industry. So believe it or not, I mean, of our startups had VR, AR, and simulation based technology in their startup idea. And as I said, responding to different domains. I think from my perspective, there are 2 ways to sort of look at it, and this is how we look at it. One is, the drivers of this change, and the drivers, as I mentioned, is one of the biggest drivers is obviously the consumer demand and the changing mindset of our consumers. They want more out of less. They are, very technology savvy, so they want advanced tech in everything that they do. And also the driver is the inefficiency in the system, the cost control, and all those sort of aspects. The other aspect that we are seeing is now the consumers are demanding change, and how the industry is responding. So what we see is the industry responds in various ways. Changing a very traditional mechanism and machinery isn't always easy. So it is a slow process that industry is driving through. So there is a lot of hybrid business models that are emerging in this sector that we're saying. And the old ways, as I said, the old ways are changing, but they're changing so slowly and surely. But one of the areas that John also mentioned that we're saying everyone focusing on is sustainability. So we had a startup that sort of works with or provides end-to-end water solution. So water reuse, water recycling. So John mentioned that it is 20% of water is used in the corporate sector. So that's where they are focused. So that's perhaps where our lens is. We want to support startups that are bringing in new technologies to the industry. We also want to support the industry. So we work, because we are a university, so we do have a lot of research happening in various areas in construction and property. So we sort of do that matchmaking, for want of a better word, between the startups, between the businesses, industry, and our researchers. And Australian government is quite focused on promotion of R&D. So there are a lot of grants that go towards that. So yeah, overall, I think I'm quite excited to see all this change. As I said, this has been one of the not the last, but one of the later sectors to go through that transformation. And I think it's quite needed. In Australia, New South Wales, where I live, Sydney, there are new suburbs in the south that have come up, and the suburbs are rows of houses and rows of houses with tin roofs. So the temperature difference, and it is just 20 kilometers from where I live, the temperature difference could be up to 8 degrees on a hot day, and which I think coming back to sustainability is really unsustainable. What legacy are we leaving? So there is now that the new estates that are being planned, we are having great focus on having those sort of green roofs, green canopies, more green spaces. So slowly and surely, everyone's realizing the importance of it. So I'm very glad to be a small contributor in this wider dialogue, I must say.
That's interesting, and I just wanted to keep that as a segue separately, which is green urban design, as you were probably mentioning, which is how do you reduce this urban sprawl and then you create denser situations, which is very counterintuitive, and they are very green efficient. So as let's pause there, and maybe I can take this question to Ankur, and let's do a little deep dive on and starting with space as a service, because that is what has created this entire focus around PropTech, and the biggest company around that used to be WeWork, where this entire thing started. So So Ankur, maybe opening comments from your side, how you've seen the transformation of traditional real estate and then space as a service, and obviously looking at it differently.
Absolutely. Technology earlier used to be something that we would look at as more of a elite, esoteric, good to have kind of a differentiator. But one thing that I've seen happen in the last couple of years, and the entire lockdown period in COVID has actually turned this from a good to have headline item to an imperative, to a necessity. And today, I would say that there is not a single aspect of the real estate business that has not been impacted by technology. Not a single one. There is no exception to this. So, if you go through the typical real estate traditional cycle, right from the stage of evaluating any option, any real estate development, any quasi-infrastructure facility, or a potential development, all of that is today getting more and more data-driven. The data is being collated from multiple sources. There are specialized agencies and specialized ways of doing it, all technology-driven. You're talking about moving on to valuations, the building information modeling systems that you have, which are increasingly complex, and now moving on to 4D and 5D, where you can actually interface them with your SAPs and all the ERPs and your financial modeling, and everything's being done there, to managing buildings. I mean, I know I was earlier in the day, mentioning to Mridul that I have been party to instances where one of the leading property consultancy facility management firms came in and said that they would manage a 1.2 million square feet facility with 160 people. And using a PropTech solution, these guys were able to manage the facility with just 1/3 of that workforce. And they are the only building, and this might be of interest to John, but they are the only building, John, in India, which have a platinum LEED rating, and in the last 6 years haven't raised their common area management costs by even a single paisa, despite facilities costs and everything having gone through the loop that they've gone through. And so what does technology do? And then you go on to the investment side of things. Increasingly, investment management's being driven more and more by technology. You're talking about increasingly even the post investment day-to-day asset management kind of roles being increasingly driven using technology. I mean, who's traveling these days? And yet you see these billion-dollar, multi-billion-dollar deals, transactions being consummated, and foreign investors are deploying that capital in India. And increasingly they are, and they do have the fiduciary duty of being able to manage these portfolios in perhaps as hands-on and as professional a manner as they would do in any other times. So of course, what's enabling all of this? There is a lot of technology that's being put to use. And like I said, it's no longer a good to have, it's an imperative. People are recognizing that, and that is driving increasing investment. And again, an interesting piece of data that I just read a couple of days ago is that these technology companies today are also some of the largest occupiers of real estate. And if you look at the investment that some of these technology companies have made, and even in more mature markets, the amount of real estate that Amazon and Alphabet today own is today to the tune of $40 billion each, $40 billion a piece. By the way, this 40 billion number is larger than some of real estate that's owned by, let's say, a Simon REIT or a Boston Properties or one of those larger REITs are not in the range of that 40 billion number. And these are again people who are from a technology background because of their sizable real estate portfolios with the geographic, global, complex footprints, and then the corporate social responsibility criteria that they have defined for themselves, the ESG criteria that they have defined as end users. There is a lot of focus that these guys are again continuing to bring in behind the scenes. So I'm sure, again, anybody who's in the business would absolutely. I mean, that's where the entire thing started off, and all said and done, I would say that WeWork, despite its debacles and mishaps, has still turned out to be a big motivator. It was for the first time that somebody realized that an idea that was a slightly different avatar had been around for decades could create something so large and make so much of a difference to the industry. And then spawned the collateral in, let's say, co-living, co-working came in. And certainly, I mean, while you could talk about the impact on office space because of the COVID story. Going forward, we don't believe that of 20%, 30%, but those are cyclical things. We do believe that it would also be partly offset by the larger space requirements. I mean, we had seen per square feet, per person square footage requirements go down to 40, 50 square feet to a person. Now we're seeing that number being consistently redefined to 60, 70. So all of those things are, I think, in balance going to play out. And which also goes on to show that historic real estate companies are today supporting entities like John's entities, and they are increasingly realizing that the success going forth is not just going to be about creating better buildings. It is not going to be about just the brick and mortar side of the story. Increasingly, it is all about being able to add a value-adding, differentiated layer of service on top of your brick and mortar offering. And technology plays a huge role there.
No, that's interesting. And I think with this, I'll go back to John to ask a question about, which we were also discussing in the previous panel, and a little bit of more of a deep dive on valuations. Because you have so many startups in your incubator, John, and Professor Rana as well. It is a little difficult for traditional financial investors. And I'm saying that so far everybody understands that there is a traditional way of valuing startups, and certainly there's a traditional way of valuing real estate. And so then somebody like, let's say, Snapshot, which has zero revenues perhaps, but is valued X amount of $1 million. And then there's something which has a recurring income like a co-living or a co-working startup. So briefly reconcile the valuation metric. How does it happen? And for all the students here, how is it different from traditional ways of valuing stuff?
So Mridul, because we work with early stage companies, not exactly. So we have startups which have zero revenue, and we have startups which have 50 lakhs a month revenue. And any startup in the interview process talks about valuation. We get up, thank them and say, thank you very much. It was a pleasure meeting with you. We do not want to deal with the fluff in the industry, because this industry is rather unforgiving. If the real estate industry, the people in this industry do not see, and I think Ankur alluded to, you alluded to, if you do not solve a must-have problem, deliver me a cost saving or a revenue upside, you're wasting my time. And startups would come to us, and within 45 minutes, we have a set of questions we ask, and if valuation becomes an overriding concern for them, then we walk away. Now, this is very, very important for us, because we are perhaps the only accelerator program in the country which takes equity for mentorship. It was extremely difficult for us in the first cohort to do this, but because my partner Apul and I had set up the Reliance Industries fund and the accelerator, we had some credentials, but nothing in real estate. So when people like Altaf and all came in, we said, listen, we will take anywhere between 2.5% to 5%. And startups who were doing 50 lakhs revenue said, hey, my company is valued at $3 million. We said, where? Toilet paper. And that's the language we use. All this valuation till such time we see serious upsides in not just revenue, but also on a path to profitability, everything is fluff. And I thank startups like Quibble, which raised $1 billion and shut in 6 months, because it just goes on to prove that valuations are bubbles. And today, investors today, when I raised funding for my first startup in 2000, I had to actually prove to them that this was a valuation. And finally, the investor didn't agree. And in 2000, the deal I struck was a 20% discount, and I took a CCD. CCDs and CCPS today are known instruments, but in 2000, it was not known. And there's a rule of thumb. When you invest, most early stage investors look at a thumb rule of between 15 to 20% of taking equity in a startup, because a good investor will want as much equity to stay with the promoters, because only then are they vested. So, we've done away with this bubble, and we today, after having successfully mentored so many startups, are very, very firm that valuation is not what we are focused on. we will help unlock value.
So, yeah, I mean, I agree with that. And for the purpose of the audience, briefly, before I go to Professor Rana, I think it's from an early stage angel investor perspective. I think the equation that you're trying to solve for everybody on the call is there is a way in which the valuation of the company grows. And then to achieve that valuation, you need more cash funding in future rounds. That creates a dilution. And so there is an enterprise value that grows, and then there is a diluted value, which is the multiple on your invested capital. And so depending on how risk averse you are or what stage you're investing, you're basically solving for a 5 to 7 or a 10x, depending on a 2 to 3 year horizon and how early you come. Now, the question, which becomes very interesting in prop tech is that on one side, you have a co-living cash flow generating situation. And on the other hand, you have a design-led proof of concept yet to be proven kind of a startup, where again, the valuation is growing. So what is the semblance in these two? And the answer is they can't be, right?
They can't be, absolutely.
Yeah, they can't be.
So for early stage startups, we just do a CCD. It is simple. Yeah. We tell promoters, let's not waste time on discussing valuation, because valuation for early stage startups, all of that. Let's just do a safe fund, 20 to 25% discount on the next round. It also then removes the friction between the promoter and you as an investor. But if you take, so there are, I'll break the second one into two buckets. If there are companies which have a BOM cost, for example, is a hardware device, we remove the cost of goods, and on the balance, we do a multiple, which could range from between 6x to 8x, depending on historics that we get from other markets. And on SaaS models, where margins are between 70 to 80%, we again work on multiples with a discount of 30 to 40% on a discounted cash flow model. But even that just gives you a handle where valuation can fall, then is left to the negotiation between the promoter and the investor. Let me give you,
sorry. In the absence of a sustainable cash flow, you're basically looking at a lifetime value of a customer from the customer's perspective and the cost of customer acquisition, and then trying to see that maximizing that arbitrage, so as to speak. So yeah, sorry, you were saying something, John. Okay, I think John has.
Yeah, no, I think I froze.
Yeah.
Sorry. So you're right. My internet connection is on. Can you hear me, Mridul?
Yes, we can all hear you.
Yeah. So there are different ways to build the same cat. At the end of the day, both the investor and the startup are aligned to growing the business. And we have also looked at innovative ways of for example, today there are hardware startups. We're telling them, do not raise venture capital to grow your business, raise venture debt. So 3 of our startups we've actually got them venture debt. You have to understand, and you know this, Mridul, that equity is the most expensive asset in the hands of a promoter. Debt is always easier. And today there are business models where companies are funding debt. So there are different ways to build this cat, and promoter and the investor.
Sure. Professor Rana, if I were to come to you and say, what's the model in which your incubator works, and does it work on equity? Does it work on grants? What's the way there?
Absolutely. Look, it's quite refreshing to hear John's comments on, valuation is not the ultimate thing. We pretty much work on the same formula. What we work on is we help startups build a foundation business first, and a high valuation business later. So the way we work we don't take equity. So we're quite different to traditional business incubators, and we don't take equity because we're funded by the university. At the same time, we don't provide capital, and we have a very, very small team, and everyone comes from, traditional work with the startups is to raise and to help build a foundational business, and we actually sort of guide the startups so that they bootstrap to the extent they can, because as mentioned before, the equity is perhaps the most valuable asset they have, and they're very eager to give that away for a very small chunk of cash. So we are very fortunate. We are in a region where everyone sort of it's a big business community, but it's a very highly networked business community. So the way we work with startups is we give them access to networks. We help them sell, reach customers, acquire customers, and as I said, do a lot of hand-holding and try and not let them dilute so early, so quickly. So that's sort of the approach we have. We do have, connections with and strong connections to the VC firms and angel investors. We work with a lot of, angel investment companies and individual high net worth profile, investors and donors as well. There's a lot of philanthropic money that we access through university as well. So our funding and support model perhaps deviates a little bit from a traditional, business incubator that you would see today. And I'm very proud to say that it works in the long run. It is beneficial for the startup, and it helps build a very strong business. If you don't have that lens on how much cash can I raise, rather we have the lens of how many customers and what sort of customers I want to acquire and what value I'm giving to the customers, so that it's not only about pumping money in the market and getting some of that share. I hope that answers your question to some extent, but that's our approach.
Yeah, so I'm just trying to contrast the two models for everybody. You're a university-led incubator service. John's a private one. John would probably be participating in the capital provision, so as to speak, in various stages. And you would be participating more on the business growth and daily active users and the adoption rates, and probably in that.
And providing networks wherever needed.
Providing networks, right. And so Ankur, let's change the topic, right? Let's now look at institutionalizing real estate, which has happened in the last 2 years. In India, you've seen REITs, real estate investment trusts. So on one hand, the traditional real estate is getting institutionalized, and then there is this technology. So where do you see this interesting mix of the two pretty much creating a lot of synergy?
They need each other.
And if you take, let's say, office assets, where do you think these things are interesting?
Well, like I said, they are no longer good to haves. They are imperatives. They are, in fact, quite a lot of this change is being driven by these institutional guys. And while we've talked about some of the high growth areas like warehousing, let's not also forget what's happening on the data center side of things. I mean, that's a real estate asset class, which is entirely technology driven, and it's gone ballistic. And so increasingly, we're seeing that a lot of these institutional investors are relying upon technology to derive increasing efficiencies out of the assets that they are acquiring. And not just efficiencies from assets that are already ready and up and cash flow yielding, right from the design process. So we were having a conversation with an institutional investor the other day where they said that our sustainability team is based out of the US. And this is, I'm sure you can guess the name, but this is one of the large US investor groups, development entities as well, who have a footprint in India. They've been doing some pretty marquee assets. And they said that our teams based out of US would like to get hands-on involved with a development management exercise that they are conducting here in India. And the good part is that there are consultants from all over the world who are working on the same design today in the building information modeling, the BIM package that we have. And today, all of these guys are collaborating almost on a real-time basis, working on putting up a design which is pretty much as close to real life as it gets. And only then do you start construction. So right from the development stage, making sure that everybody's on board, everybody's inputs are captured, and not just on paper, these are all incorporated. The synergies between each of their inputs are captured. From there, going on to things like managing and observing the entire construction time cycle, not just the development process, even the cost and quality monitoring is all happening through technology, all driven by these guys. I mean, there is a significant upfront investment that you do need to make. There is a complete ecosystem that is involved in developing or coming up with any project, and the entire ecosystem needs to be evolved. And I've seen that some of these people, some of these overseas players, some of the Indian institutional players are actually doing a lot to inculcate that technology friendliness. I mean, the first time my clients and we started talking about a BIM-based modeling exercise, The architects were aware of it, but then the structural guys session, and that's where the hand-holding has to happen. You need to go through that entire thing. But once you get on board, the efficiencies, the synergies are tremendous. And not just at the design stage, like I said, during the development process, during the construction process, even simple things like site visits. I mean, we are seeing transactions being conducted today with all virtual site visits being done. You're using drones, you're using all kinds of technology efficiencies. You've got all these, even for residential sales, we've seen people like some of the leading brokerage houses, some of the leading developers come out with brilliant interfaces which allow you to transact, negotiate, make offers, counter offers, have everything put in there in a single repository of sorts to make things happen. And even these institutional investors who are putting in money into warehousing, they are all coming back and saying no longer is it about putting up just the brick or the prefabricated structure. Increasingly, warehousing investors as well as occupiers are saying bandwidth is a prerequisite. I need high-speed bandwidth. I mean, we were recently helping out with an industrial negotiation where a build-to-suit was involved, and having broadband bandwidth there because they wanted to bring in all their best practices, abilities to monitor, improve. It is a given. Similarly, if you talk about things like post-construction, day-to-day asset management, day-to-day monitoring of how the so there are intelligent sensors being built into even simple spaces like warehouses, where clients are insisting upon monitoring, and certainly the more sophisticated e-commerce occupiers are insistent that not only would they monitor simple things like the fire safety or water tank availability or the activation abilities of the protective equipment, they also want to be monitoring the ambient air quality and the lighting lux levels on a real-time basis. And there are sensors available today where these guys sitting on a cloud can monitor all of this, and they are insisting that all of this be incorporated into the properties. And it certainly brings in, and people think that in the short term there is a capital expenditure element involved, which is true. But then there are people who are again innovating there and going back to financing this. So there are models in which all this initial capex can be converted into an OPEX only model that is being achieved today. And then these kind of efficiencies that come into the system because of all this technology implementation are, the break-evens are not long. There are higher efficiencies. There is a clear sustainability positive impact. And then the costs more than pay back for themselves. And that is all very, very interesting to all these institutional guys, because all of these guys are today raising money. And when they go back to their own LPs in whatever parts of the world, institutional investors who are backed by these LPs increasingly have to respond to your ESG commitments. Every single place that an Amazon, for that matter, puts up a warehouse, they make a clear, conscious attempt to define what would be the amount of local employment they'd be generating. So they go down to that level of granular impact, and then ESG is a very important criteria. And there is money that is actually available today in a more cost-efficient manner if you happen to put up a green building. So I think it's all kind of a virtuous cycle where you want to do things better. The fact that you are able to do things in a more sustainable manner allows you to become more efficient. Capital is willing to appreciate that. Investment managers are willing to give you greater credit for that. It adds to your own credibility, and it adds to your overall rating as a development or an investee company. So it's all, like I said, a very, very virtuous cycle across asset classes.
Sure. I think that's a very comprehensive view, because I remember there is even the financial instruments are changing, right? So when you talk about green buildings, you're talking about green bonds. And recently, I think last month, there was a blue bond, which is based on oceans and circular economy around that, right? So maybe for another day, we'll leave that conversation. But given the fact that we have students here as the audience, so maybe Ankur, you and I are alums of this place. So what advice would you give to all the students who are logged in? I think there are 200 odd students here. How should somebody go about their career after you've done a master's degree in business economics or finance? How do you plan yourselves out in a post-COVID world? What skills should you have?
Yeah, certainly. I I was privy to the previous sessions, and there are a lot of thoughts, but all said and done, property is something property is not as evolved, all said and done. While it might be the largest, it is the largest asset class globally, and it plays out to your advantage in various ways. I still believe that the biggest single thing that I check for whenever I've tried adding people to my team is that I am very keen to see the passion that people either understand the property business, they like the property business or not. And I don't believe I've had enough instances where people who were from financial services backgrounds, they tried dabbling into property businesses and then they said, no, this is a little too much for us. It's a little too chaotic. It's a little overwhelming as well. Coming out of the campus, I would say if you feel that you have a passion for property, certainly give it a good shot. If you've done your internship and if you found this to be of interest, but whatever you do, whatever, and I'm a firm believer that whatever in life you do, you need to be fully committed to it. And it has to come from the heart. You need to feel passionate about it. If you don't feel good about doing it, don't do it. The world today offers enough options. But if you really decided that you want to go into the property segment, then do not be afraid, or do not be very, very open to appreciate the impact that technology can bring in. In fact, very often we come across these young entrepreneurs, and I'm sure the esteemed panelists here would have seen a lot more of these cases than I have. But young people out of the campus these days come out with such brilliant and simple, sometimes you feel, why is it that they can see the world in such a simplistic manner and take such simple things? But it's amazing, and it's quite encouraging. And technology will change the way real estate is being done. It is already happening. And if you look at some of the recent research, which in general talks about how the world is evolving, whatever mankind achieved between 12 years, we are today probably seeing that same evolution cycle happen in less than 3 years. So I think it's not just now, but even going forward, you will see a lot more change happening in the next 5-7 years. For fellow campus students, for people from the Department of Business Economics and Financial Studies, you should certainly learn as much as you can about real estate. A lot of the best practices that are being seen in financial services are being implemented in real estate. And going forward, real estate, I would say, and as Ms. Rana mentioned, real estate is one of the late evolvers, so to say, in this entire evolution cycle. And there is a lot of room for innovation across the board. Clearly, a lot of the models that are being tried in West, they are being ripe for being replicated as well. I mean, we don't necessarily even have to be 100% innovative or path-breaking about it. But a lot of the models that you're actually seeing in the West, they have to be Indianized, they have to be contextualized, and then there is a lot of room for them to be evolved and implemented in the Indian context. For students, if you like real estate, plunge in. Don't worry about the money side of it. Trust me, we've had some tough years in real estate, but I think we are heading for some very interesting times ahead.
Mridul, can I just add to it?
Yes, I was about to come to you only. And also, if I want to apply to your incubator, what skills do you look for from students?
In entrepreneurs, yes. I teach on entrepreneurship on behalf of Launchpad as well. So I work with a lot of student startups, and in fact today we were running a program for Vietnam, and I was teaching our Vietnamese students, bringing entrepreneurship to them. So whatever Ankur mentioned resonates quite a lot with how we work with startups as well. So passion is absolutely the must. If you feel for the problem, you will have the drive and the motivation to solve it. I totally agree with, once I read somewhere that whatever, I'm a writer too. So I read that, whatever had to be written is always written, but now you need to write it in your own words. So similarly, don't be afraid that things have been done before, because I'm pretty sure that you can bring your unique angle into it and find value that you will derive for your customers. Having a global outlook is really important, seeing what's happening in the world. And as Ankur mentioned, Indianize it, contextualize it to your local environment and launch a startup. And what better time than now? You're students, you don't have all the responsibilities and the dramas in life that that we have to go through as in our working life, quite constrained. So I think it's the best time to sort of practice. I teach entrepreneurship as practice and play. So you launch small products in the market. You start with small things and you see where it takes you. And most likely, what happens is what you start with, you don't end up with that. As we see quite often. So I think, from my perspective, giving it a go is the most important thing, and then keeping at it, persevering is another important thing, and accessing expertise and talent that you have around you. There's Mridul, there are other, your other professors, lecturers, there are contacts like John, Ankur, and so having that expertise and approaching them and learning from them and having a global lens is important. It will take you somewhere.
And I think coming to you, John, as you have the last word before we open it up for question and answers. If somebody was to apply to Brigade Real Estate Accelerator Program, and more specifically, somebody who's looking, all these students are looking at a career in Real Estate 2.0, which is 2020 onwards, what skill sets would you want to look at them?
So, Mridul, just going by the alumni at your institute, I think your institute inculcates a sense of adventure in people. So the first thing that we look for example, I'm right now hiring 4 people. I need a business analyst because we're in the process of setting up a fund. I'm looking at an investment analyst, I'm looking at a content manager, and I'm looking at a program manager. We don't look for aptitude, we look for attitude. We look for attitude, and we look for the hunger in the individual to make a difference. In fact, every candidate that we interview, we give them a project. And the amount of work, so passion, I heard the word passion, that has to, while passion in an interview can be very easily articulated and shared, it's the passion with which you attack a problem that's key to us. And to the students on this community, real estate is the last, perhaps the second last frontier where technology has not yet hit. I try to disrupt religion, that's a story for another day. And I work with, Symbiosis Institute of Entrepreneurship, IIM Bangalore, and I tell youngsters, take the risk now. Your parents are paying for your accommodation if you guys are based in Delhi. If you're based in Bombay, parents are paying for it. Take the risk. For God's sake, make as many mistakes as possible, because it then shows that you're experimenting and trying something new. Don't be afraid to fail. Because failure is, in fact, when I failed the first time in 2010, one cyber bully took me on because failure was a stigma in 2010. And I took him head on. I remember within a month, because I took him head on, I had 4,000 followers on LinkedIn. Failure is not a stigma, ladies and gentlemen. Failure is the pivot, is the stepping stone for doing the right things going forward. And today you have large number of people who are willing to pick you up or guide you through the journey. You have people like Mridul, Ankur, Inu. You have successful founders. You have founders who failed. You have incubators. We didn't have all this when I did my first startup. So go for it. Real estate is the right space to disrupt, because it desperately, like I showed you, it desperately needs intellectual and all the help it can to get out the tsunami after tsunami after tsunami that's it's been hit with. So that's my advice to your students, Mridul.
Sure, thanks for that. And that's advice well received from all 3 of you. In the interest of time, there are few questions, but I'll take 1 or 2. I think we have overrun the time, but maybe 2 questions. Is that right, Riju? We can go ahead.
Yes, we can.
Okay, so one question relates to user experience, and that's very interesting because it says customer experience has been the focus for many industries in designing solutions, right? And how can this be articulated well for real estate? So how do you, John, so let me direct this to you first, and maybe you can also join in. When you're designing a solution, what components of UX UI, the user experience, the user interface, are actually playing a more important role than the technology itself in real estate?
So Mridul, 20 years back, 50 years back, real estate was the promoter went, saw a piece of land and decided to build a residential complex. Today that's changed because competition is so heavy that a lot of customer research goes in to decide land use when you look at a property. In COVID times, I'll tell you, at Brigade, they're looking at residential buildings with small offices that are comfortable to work in. This was not a requisite, 1 year back. And every challenge throws up new opportunities. Okay, for example, today, Brigade, being one of the largest developers in South India, has thousands of both owners and residents staying in Brigade properties. How are they connecting them on one platform to make sure that customer anxiety, customer celebrations, customer pain points are addressed at the click of a button? And coming to UI and UX, we just held a workshop last week on design and in sustainability. And what is coming through very clearly is that urban design thinking in urban systems. So we had Naresh Venkatraman, who's a very well-known architect, saying, listen, this is all junk. And we had Nariman, who said, this is not junk. It was an interesting meeting of minds, but at the end of the day, they agreed that customer comfort, not just within the premise, but also the envelopment, which is the finances, how far is it from places, all have to be taken into account to define that user journey. So today, real estate companies are spending adequate money, time, resources, investing in research, understanding consumer needs and wants. And there's a difference between needs and wants, and then building projects to suit those requirements. And that's why they're standing apart from the other guys.
Sure, and Professor Rana, very briefly, this dichotomy between deep tech, and which is something that you support, and then the UX UI, which is because deep tech does not result in good UX UI, right? You probably don't see it. So maybe a few comments on that.
Yeah, look, just adding to what John said, we're seeing a lot of focus on customer demand, as I said, how customers think and what they want, etc. I'll give you two very recent examples that we're working on and how we brought, how we made the models very customer centric. So one is going a bit further from John's example of bringing offices closer to homes. So Western Sydney University is actually working with Lancome to have those, we're calling them work hubs, and work hubs is a very traditional term. So you would think that, these are office spaces. But what we're doing there is people want to work out of offices, but they don't want to travel that much as they used to before. So we're bringing offices near home, and we're also merging that with education. So not only the people are going to work from those spaces, but we'll also get education from Western Sydney University in those spaces. So that's a hybrid model that I think we are creating and is being created. And a lot of our startups is also involved in various services that are going to be, given to those customers. So that's one example. The other example I have is we have got a local furniture manufacturing company that we work with. And as you mentioned earlier about circular economy, so that's also a big area of focus for us. So we're working with our industrial design, institute in Western Sydney University to sort of have sustainable design built into their furniture, and also working on their business model so that traditionally what happens is you sell the furniture and that's the end of the story. So we're providing end-to-end, we're helping that company provide end-to-end solutions. So they will supply the furniture and on a lease model, and then take back to take care of the waste management for that company. So these sort of hybrid models are emerging, and they're emerging because of the changing consumer demands. Now, having, you very rightly said, deep tech is something that is felt and not seen.
we'll probably
Yes,
end
sir.
with that.
Yes,
One more
it's
minute.
fine.
So Ankur, this is a question for you, which is, if you're using too much of technology, does it not expose you to more risk? So the question specifically is, with the plethora of real estate scams happening in India, with the latest one being the Manesar property scam, I don't know what this means, but maybe there is. How do you spot a potential scam without a physical inspection of the property? So would it lead to more scams, or would it actually? So the question is, does blockchain lead to more scams, or does it actually take care of everything, right? In a different context.
Right.
And maybe Ankur, just a minute, because I think we've overrun.
Okay, sure. See, just the way the oldest of human emotions will continue to remain with us, scams will continue to happen. All said and done, greed is a factor that will continue to remain in play as long as humanity exists. So the simple thing in real estate is, if it's too good to be true, don't put money into it. It's as simple as that. Technology can help you. You can certainly be more intelligent about it. You can certainly, reach out to. There are increasingly ways available. Most good real estate projects are today rated. If the developers raised any kind of credit on them, they are rated. There are third-party agencies who would give you drive-arounds, drone shots, videos, and you can certainly do your own diligence. There is no substitute. But what technology is enabling is that the amount of diligence, the amount of desktop information available, the amount of desktop diligence that you can conduct is much deeper. And certainly the regulatory environment today, again, you can go to the RERA websites, and thanks to technology, there is a lot more information available on the local regulatory websites, from the banking system, from even the social forums. You can go down and see what people are saying in their direct messaging exchanges on Facebook and other places, and you can find out a lot more. And then the simple thumb rule is, people will be greedy. Real estate is a big asset class. It's easy to, it was relatively easier to fool people. It's getting tougher. The government guidelines are tougher. Technology is certainly bringing in a lot more transparency. And the simple thumb rule is, don't get too greedy. If it is too good to be true, you are all finance guys. You know the cost of capital. You know the cost of returns. You understand risk. If it's too good to be true, stay away. Dig deeper, you'll find out the truth. Otherwise, always reach out.
And Ankur, just to add to you, Mridul, in our current cohort, there are 2 legal tech startups where you put in a property khata number and you'll get every fraud that property has gone through. And this is thanks to what Ankur said. Today government's also getting more transparent. And this company called PropCheck has evaluated 50,000 properties for 6 banks and has come back with 100% accurate results. So it's a company called PropCheck. We have another company called LandRight, which is KYC for land and property. That's how we position them. So legal tech is becoming a very, very good handle for people to figure out historic, because fraud is not 10 years, 15 years. It could be 40 years back, and they're digging deep. Just to add, Ankur, sorry, I just thought.
Perfect. No, this is brilliant. Thank you. Yeah.
Oh, thank you. I think we've run completely out of time, but physical world, if it is too good to be true, then you check. But in the digital world, you have to believe it before you see it, right? So I'll leave it at that and hand it back to you, Rijul. And thank you once again. A virtual applause to everybody, if there is one, but back to you, Rijul.
I would like to thank the panelists for sharing the valuable insights. That was indeed a very enlightening discussion with the introduction of the PropTech sector. Thank you so much, everyone. It was a very enlightening session.
Sorry once again, Mridul, because I'm not visible. I can afford to be in my informals at the weekend. And yeah, good afternoon, everybody. I'm Professor Sanjay Sehgal this side.
Good afternoon, sir.
Let me start by thanking Mridul and Ankur both for your contributions, and particularly John. I was listening very keenly. I had a brief interaction with Gautam, your colleague, about 10 days back.
Sure.
And in fact, I look forward to having a meeting with you and your colleagues sometime next week, because we at the department have resolved, we're setting up an innovations lab actually, but focusing mainly in the first phase on fintech, proptech, and analytics. Of course, we will expand it to other areas later. And we have the capabilities in terms of the university stamping to launch e-learning programs, as well as our very strong alumni to mentor in the field of proptech and fintech. And so maybe sometime next week, I'll request you to set up a meeting and we can discuss about something which we can do exciting with you.
Sir, look forward.
And also, nice to hear you after a long time. And yeah, and I would look at deepening the ties with your incubator, with our incubator now once it goes live and working. And so
absolutely, I look forward to it.
We look at more interaction, including between the incubators on both sides.
Absolutely, sir.
Yeah, thank you so much for being with us, and I'll hand it over to the anchors who want to do the final thanking ceremony.
I think Professor Manish Kumar wanted to.
Yeah, Professor Manish, sir.
I was actually enjoying this session, and I could see two things. One, the energy that is coming not only from the experts who are working on these, but from our own students. It's a matter of great pride for me to be associated with this kind of a revolution that is taking place. So many students are listening to and actually, getting exposed to the nitty-gritties of entrepreneurship and innovation. I think it is a wonderful time for higher education. I must appreciate the effort of the department in putting these things together and exposing the students to such things. I'm really very happy and, of course, thankful to both Mridul and Ankur. They have been part of our MFC fraternity, and particularly Mr. John and Inu. Inu, I met you. I remember.
We have, yes.
Yeah. And Mr. John, I was really impressed by the presentation by Mr. John. I'm really very happy to see that a lot of work is being done in this direction.
Thank you, sir.
Thank you very much for having spared your valuable time for this. And please maintain this kind of contact and support to the department. Thank you.
Thank you.
Thank you for having us.
Thank you.
Thank you, sir. Like I said, always a pleasure to get back to the campus, and thanks a lot. Thank you for having us over. Thank you, Mridul.
Thank you, Mridul.
Thanks, John. Thanks, Professor Rana.
Yeah.
Thank you.
Thank you all.
Meet you all. Bye-bye.
Thank you. Bye-bye.
Thank you. Thank you.
Excuse me, ma'am. We are coming up with a thank you note for all the speakers we have here today.
Yeah, go on, Piyush. Go on. Yeah.
On behalf of the AFCON, Department of Finance and Business Economics, I thank Mr. Ankur Srivastav, Mr. Mridul Upreti, Mr. John Kuruvilla, and Ms. Inu Rana for the insightful session on the role of technology in real estate. The information you shared was very enlightening. We hope that the students gained valuable insight from the session. With this, we come to an end with today's sessions and discussions. But before signing off for the day, we would like to thank Professor Sanjay Sehgal sir for his efforts and guidance to make this insightful event happen. Professor Sehgal is very passionate about entrepreneurship and creating an incubator for the students in DFBA. We thank him for the efforts he is putting in building an incubation center for our campus, and we hope that his dream turns into reality at the earliest. In the end, we would like to thank each one of you present here for joining us, and we hope you all will be joining us tomorrow for more such enlightening sessions. Thank you.
Okay. Thank you.